Hi, in this video we'll be discussing with Aniruddha Nahe, discussing at length about his experience in the industry and the process flow as well as the fund selection process which has been followed in PGIM. Hi, this is Uday from ECSMF.com. As this video is all about PGIM Mid-Cap Fund, before getting into the fund itself, let's have a small intro of Aniruddha Nahe himself, who is managing this fund.
Anirudh, can you brief us your fund and slightly about yourself, on this?
Sure. So again, thank you there. Thank you to you and your team. I've been in this industry for almost 2 decades now. Started my career with DSP as an analyst, and then I moved on to become the fund manager for DSP BlackRock Microcap, which was then called the Microcap actually. Then 2010, from between 2008 and 2010, I got an opportunity to move abroad with Mire in Hong Kong. So I was with them for about 3 years before coming back to India. I joined IDFC Mutual Fund, and I used to manage their IDFC Sterling Fund and the IDFC Tax Advantage. In the post that, for a brief stint, I was heading the PMS of Avendus before joining PGIM in the month of April 2018. Since then, I have been managing two of their funds, the PGIM India Mid Cap Fund and the PGIM India Diversified Fund.
As you can see, it's a very vast experience which Aniruddha Nair holds in the industry. Let's hear from him. What are his views and his thought process before selecting a stock, and in general viewpoint of the market itself.
Yeah, and let's start with mid cap. As a strategy, how do you feel like the fund has performed, and what do you feel with the present scenarios? How do you feel the fund is going to be performing in future as well?
So they actually, speaking on future performance is very tough, and the stated policy is please do not go by the historic returns. That's what mutual funds say. Our only sense is returns are made when you buy a good business at a reasonable valuation. So our philosophy has also been growth at a reasonable price. So what we clearly look for while buying into a business is that there are two legs to earning returns in a stock, or a business. One is there should be EPS growth going ahead. The earnings growth will drive prices. And the second thing, which is usually not talked about, is they should be bought at a price where there is a chance of a PE re-rating also. Now, if you buy a very expensive stock which has earnings, you will probably not enjoy the PE re-rating chance. Our sense has always been to buy a good business at a reasonable price. We would probably not buy the best business if it is very expensive, because we are very sure that those businesses probably will not give you the second leg of return, which is the PE expansion. Now, if in any scenario in the market, if we go ahead and take a 3-year view of building a portfolio, and that is usually what we do, we take a 3-year view of building a portfolio. There are going to be invariably certain businesses which are undervalued, good businesses, going through the bottom of the cycle. And hence, if you take a 3-year view from wherever you look at the markets, these businesses will generate good return over the next 3 years. And that is what we keep trying to look out for. Good businesses at a reasonable price. And hence, that's how we build the portfolio. In the month of November, December, January, we went and bought Pharma, which was completely disliked at that point of time.
When was that?
Pharma.
Before March. Before March.
In the month of November, December, January. Our only sense was these were good businesses. Only their P&L was a little bit impacted because they were not seeing growth. And then COVID happened. We've been lucky. We took a 3-year view that over the next 3 years we should make good returns. Some of it has been front loaded, but it has worked well for us. Similarly, between April, May, June, we went ahead and started buying into auto and auto ancillary. Again, good businesses going through the bottom of a cycle. And over the next 3 years, we think they should do well. Presently, a sector which was really loved over the last 1 year till about February, March, and then people have just given up on it for some time. Uh, that is where we started adding again financials. We think they've raised.
Basically, to put across, you're looking for value stocks, something like that, in mid cap.
Not exactly. See, where we beg to differ is people divide the market completely between value and growth. You can actually be at the between in the center. There is a space called growth at a reasonable price. So we are focused towards growth, definitely, but it must come at a reasonable price. Value could be such stocks which are at deep value, which probably have no growth prospects also. So our idea is to pick good businesses which have growth prospects over the next 3 years, but it's just that in the near term it is going through a tough phase, and hence people don't look at it. So to give you a sense, pharma was something, auto ancillary was something. Today, financials is exactly where these sectors were about 3-4 months back, and that is where. And if you look at it, financials have actually been a growth sector. It's not been a value sector.
Yeah, obviously. So obviously, it has been like, till February, no one was actually looking out of banking. No, everyone is actually looking out of banking than banking.
So we were actually big underweight on financials last 1.5 years. The reason was we clearly saw the risks, slowdown in economy, and there were three other risks associated with that. One was this is the most leveraged sector in the business, among all businesses, and we don't like leverage. This was one of the most overowned sector, and this was one of the most expensive sectors. So in a slowdown, you had all the three things going against you. Today, when you look at it, uh, valuations have corrected. Uh, they have raised capital, and it is pretty under-owned also. So everything is right probably now to take a 3-year view on this sector and go ahead and build it.
How do you feel mid cap as a this thing after this multi cap rejiggle and all those things? Do you feel allocations will go more into mid and small cap funds rather than large cap? Do you think large cap has still legs to run or something like that, or people will start looking for mid and small now?
See, large caps, I think so. Next year, because of this year's, subdued earnings, next year across the market cap, large cap, mid cap, small caps will show very good earnings, and hence to that extent, large caps also has the upside out here. But having said that, I think the larger upsides over a period of the next 3-5 years could be in the mid and small caps. There is no doubt. If you look back in the last 10 years, let's say 2018 or 8 onwards, the last 12 years, I guess there have been huge number of businesses where massive re-rating has happened from stocks moving from small caps to mid caps and mid caps to large caps. I think so. Over the next decade, also, you're going to see a very interesting businesses getting listed, and a lot of businesses graduating from becoming a small cap to a mid cap and mid cap to a large cap. So, to that extent, we remain very positive on the mid and small cap space with a 3 to 5 years perspective.
One particular view which has been putting across is on the airlines and the hospitality sectors, all these things. How do you feel is the right time to enter in this sector specific call as
So,
the fund manager?
so I think so. Because of COVID, where it is, the entertainment industry, airlines, multiplexes, restaurants, hotels, etc. This sector will take time to recover or come back to normalcy. The primary reason is because this sector generally requires people to be very close to each other in that sense, whether it's the airline or you're having food at a restaurant, etc. So safety norms will ensure, and that is what the government has been trying to slowly unlock these sectors.
As
Uh,
a fund manager, when are you planning to look into those sectors as a whole, actually?
Sure. Frankly, we've not been big in these sectors anyway, because what we have found is usually these sectors are very asset heavy, especially hotels and restaurants, then your multiplexes, etc. And asset heavy businesses, if the break evens are high, which usually it is, the ROE ROC generation of these set of companies have been pretty subdued, and hence to that extent. Even pre-COVID, we were not big we didn't have much of an exposure. In fact, during COVID, pre-COVID, buy into these businesses.
Now you know about the viewpoint from Aniruddha Nahe himself. Let's also understand about the process flows of the company as well as fund itself from Aniruddha Nahe.
Yeah, sure. We wanted to highlight something which is basically what our process has been, and this is something that has really helped us, be more objective in selecting stocks, and it has helped in reducing mistakes for us to that extent. And that is one of the things that we keep, we are very proud of. So what we do is in the process we start off with our cash flows, focus on cash flows. Any business that we look at the history of a business and try to see that at least any business which is getting coming into the universe, it must have positive operating cash flows in 70% of the history of a company. So if the history is 10 years, 7 out of 10 years must have positive operating cash flows. The second thing that we looked at is clean balance sheets. So net debt to equity has to be less than 2. And the third thing that we look at is there should be no major corporate governance issues. These three things put together has ensured, especially the balance sheet ratio and the cash flow ratio. These are very objective ratios, and hence, irrespective of what an analyst or a fund manager thinks about a stock, if they do not fulfill these two criterias, which are very objective, they don't come into the portfolio.
Do we get with a debt to equity of 2? Do we get enough stocks? Is what
Yes, yes, boss. There are enough businesses in India which have a net debt to equity of less than 2.
So you
The
have
IT,
challenges sometimes, right? Maybe if it is by a little bit more, also you may feel the value creation may happen with that stock, but still
yeah,
you'll neglect it. Is it?
not that. See, when I'm saying net, I'm not looking at gross debt to equity. I'm looking at net debt to equity. So gross debt to equity might still be higher, but if it has cash, it gets deducted from your gross debt to that extent and brings down the net debt. If you look at the good businesses in India, the IT sector, the pharma sector, the auto ancillary industries, a lot of them actually the complete industry fits into this segment.
IT,
Agrochemicals
so
and chemicals.
obviously it will come.
Yeah. So I think the only industry which doesn't fit into this in any way is your lending businesses, financials, but we don't judge them on the basis of this criteria for financials.
Absolutely. No, and in fact, I basically just wanted to say that, obviously there is a ready reckoner that we keep talking to, people about, and where, the whole essence of, the portfolio management that we as a funder has been doing is to, try to have as minimalistic overlap with the index in the best possible way, and also to look at, trying to have a minimalistic overlap, at least with competing funds. I mean, so to say, it is not that it is conscious. It is just that the portfolio pick and the construct has been such that when we observed it, we realized that the overlap that we have even with the index is hardly under about 30%. And hence that really shows that somebody who's getting into good product portfolio will definitely have the benefit of participating in a reasonably good rally as well.
Yeah, so it was a very healthy conversation, actually. So to be frank with you, Anirudh, thank you very much for giving insight about your funds. So same with Rakesh.
Thank
Thank
you.
you. Thank you very much.
Thank you.
Now we got to know what is PGIM Mid-Cap Fund from Aniruddha Nahe himself. If you have the conviction what Aniruddha Nahe holds for his fund, and if you want to invest in this fund, we would recommend you to invest by downloading our app ECSMF, which is available in Apple as well as Google Play Store, which you can also download using our website www.ecsmf.com. Please do like, share, subscribe, and don't forget to download our app.